Welcome to Piston Pundit, your ultimate pit stop for all things automotive. Today, we're revving up to explore a hot topic: China's decelerating EV market. Once a trailblazer in electrification, China now seems to be pumping the brakes. As EV sales slow down, mirroring a global trend, manufacturers are wrestling with not just boosting sales but also turning a profit. Join us as we investigate the reasons behind this slowdown and why we think China's EV market could be heading for a downturn. Let's kick things off with our fifth point: the deceleration of the EV market. In recent years, China's EV market has seen a surge, with plug-in electric cars, including battery electric and plug-in hybrids, reaching 8 million units in 2023. They currently hold a market share of around 37%. However, growth has slowed significantly. In 2020, the share of plug-in electric vehicles was 6.3%, rising to 15% in 2021 and 30% in 2022. Last year, growth remained at 46%, indicating a loss of momentum. This percentage includes both EVs and plug-in hybrids. Solely looking at EVs, they accounted for about 25% in 2023, with year-over-year growth of just 31%. The past year saw a rise in plug-in hybrids, which increased by 80% and accounted for 12% of the market. Just like Americans, Chinese citizens are starting to prefer plug-in hybrids, likely due to their lower cost and the absence of range and charging anxiety. With the Chinese economy losing momentum and the financial power of its citizens notably lower compared to North America and Europe, Chinese citizens are opting to invest in real estate over expensive electric cars. Furthermore, the phase of early adopters seems to have passed, and the middle class appears hesitant to embrace these new modes of transportation. Point number 4: dealerships hitting the skids. Last year, China overtook Japan to become the world's largest car exporting nation. Despite their global success, Chinese car makers are facing challenges at home. The era of massive growth, including EVs, has plateaued. Car sales peaked in 2017 with 24 million units sold, but last year ended with just 21.7 million. The slowdown has hit dealers hardest, with thousands declaring bankruptcy due to the overproduction of electrified cars. Even major players like Guangdong Yonggao Investment Group, which had 80 outlets selling brands like Honda, Volvo, and GAC Aion, have gone bankrupt. This has left thousands of customers in limbo, unsure if they'll receive their vehicles or refunds. Insiders report that this downfall has been ongoing, with complaints about unpaid wages surfacing since last April. Today, it's clear that the company's employees have been owed wages for months, with little hope of payment. Before we delve deeper, do us a favor and smash that like and subscribe button. This helps us reach more auto enthusiasts just like you. Now, let's shift gears and steer towards our next point. Point number 3: the emergence of EV graveyards in China. EV graveyards, currently unique to China, could become a global phenomenon if the aggressive push for EVs continues. These graveyards, found in many large Chinese cities, are filled with hundreds, even thousands of abandoned EVs. This serves as a stark reminder of the importance of balancing demand and supply. Years ago, China went all in on electric cars to gain a significant role in the global market. This led to a boom in Chinese EV startups, with over 500 EV manufacturers by 2017. However, this growth was unsustainable. Despite government support, these startups struggled to sell their EVs, leading to an organized scheme where EVs were sold to car-sharing companies but rarely used. These EVs, often lacking in range and performance, ended up in EV graveyards. This was how smaller EV companies secured much-needed financial support. However, their inability to sell their EVs in the regular market led most of them to bankruptcy. From over 500 EV startups in 2017, the number dwindled to 91 in 2023, and all signs point to a continued decline. We'll delve into the reasons for this shortly. Point number 2: bankruptcy looms for most EV manufacturers. As we've previously discussed, Chinese EV startups are facing significant challenges. Despite managing to sell a respectable number of vehicles, they've yet to crack the code on profitability. Accustomed to substantial government support, these affluent startups have failed to navigate the complex terrain of the EV economy. The result? Only a handful of companies are actually turning a profit, while the majority are hemorrhaging money. In recent months, we've witnessed several EV startups filing for bankruptcy. This includes some big players, companies that seemed incredibly promising just a few years ago. Take, for example, Evergrande New Energy Auto, part of a larger conglomerate with seemingly limitless resources. Despite its advantageous position, it never figured out how to turn a profit or sell its models in significant numbers. The latest figures suggest that this company lost a staggering $17 million on each vehicle it sold. This isn't an isolated incident. Numerous other companies have gone out of business, including Letton, VW, and Neutron. Even companies like NIO are struggling. The Shanghai-based company recorded a massive $2.9 billion loss in 2023, despite impressive sales figures in the fourth quarter. Over these 3 months, the company managed to sell over 50,000 vehicles, but the latest estimates suggest that sales will slow significantly in the first quarter of this year, with expected sales figures of around 30,000. Point number 1. The future looks grim for most EV manufacturers. With the EV market decelerating, it's clear that most EV companies are headed for bankruptcy. As we've mentioned earlier, the number of companies has dropped significantly from 500 just a few years ago. Today, it's estimated that around 90 companies remain in the business, but if our insiders are to be believed, at least a third of them don't produce more than 500 vehicles quarterly. Their days are numbered, but they're not the only ones facing an uncertain future. If we examine the current market share, it's evident that the top 10 brands account for more than 80% of the plug-in market. Moreover, BYD holds 33.8% of the market. Tesla accounts for 7.5% of the plug-in segment, while other notable players like GAC Aeon, SAIC GM Wuling, Li Auto, Changan, and Geely each account for 6% or less. Considering that BYD is probably the only Chinese EV maker that has made EVs profitable, and the ongoing price war initiated by the same company, it's clear that the majority of the remaining companies will soon disappear. Eventually, the number of Chinese EV companies will dwindle to just a few, including Chinese legacy car makers like Geely and MG, which can survive this price war only because of their strong position in foreign markets. Thank you for joining us on this journey through the automotive landscape. Don't forget to subscribe to Piston Pundit to stay in the loop with the latest vehicle updates and upcoming videos. See you in the next episode, gearheads.